if there is any perception that something might go wrong and my deposit might not come back, there is a herd, there is a run, there is a rush to withdraw the deposits. The run is there and the bank collapses. It doesn't take much time for a bank to collapse. Our banking system is not at all exposed. Or I don't perceive a threat to Indian banking system from this kind of crisis which is coming up.
The most serious crisis to hit the American banking system and the overall American economy in terms of a systemically significant institution going bust, failure of the Silicon Valley Bank has sent tremors down the global banking and finance sector. Firefighting to contain the fallout began as early as the news of the collapse spread on Friday. Biden administration is in a huddle in Washington. But what the world is worried about is if this might lead to a repeat of 2008, the biggest financial crisis in recent times. To help us understand the scope and scale of things that have happened and things to come, I am joined by former Finance Secretary Subhash Garg and author of the book, The $10 Trillion Dream, The State of Indian Economy and Policy Reforms. Thank you for joining us, Mr. Garg.
Thank you, Abhishek.
So, collapse of Silicon Valley Bank, while the world was still trying to adjust to and understand what kind of a fallout this is going to have. Come Sunday, one bank was shut down, Signature Bank, and then just a day later, so in other words, in a span of what, roughly 72 hours or less, we are hearing that First Republic and then a fourth bank, the Pacific Western Bank, might also be in trouble. So help us understand the scope and scale of this problem, sir.
So see, the banks have this typical business model where you have the liabilities largely from the depositors, but of course, to some extent from the equity holders, some bond buyers, etc., but in bulk, the depositors. So that is where the funds which you lend comes. And then you have the lending, your asset side, where you lend your sort of funds to the businesses. And so this is, and the bank makes money or carry out this business by sort of lending deposits to the borrowers and the buyers. Now, in this system, the depositors are little bit sort of edgy, short on fuse, unsure, volatile element, right? Because their money is at stake. If there is any perception that something might go wrong and my deposit might not come back, there is a herd, there is a run, there is a rush to withdraw the deposits. Now, the bank has already lent those deposits. It doesn't have. And its asset side is sticky. It can't convert them into cash immediately and pay back. And that is the reason wherever the perception that the assets of the banks are not going to be convertible in liquid, and my money or my deposit is at risk, the run is there and the bank collapses. It doesn't take much time for a bank to collapse, because if you, out of 100 rupees, you lent 100 and you don't have even 15 or 20 or 30 rupees withdrawn, the bank is gone. It just can't pay. Right? That is the reason why it happens. The current crisis is again of the same. Its assets were more problematic. Its assets were mostly in the startup businesses, the new age businesses, unlike the earlier one, 2008, when it was more of the housing side or something. So over last few months, if not, let us say one and a half years at best, the Fed is tightening the interest rates, raising interest rates to bring down the inflation kind of thing, which is raising the cost of money. So depositors are sort of having a little bit better time. They can get more out of their deposits. But on the lending side, these businesses like startups, if their profitability is at stake, they find it more difficult to pay. Or if the bank has invested money in the bond market, where earlier it was getting lesser rate of interest, and now the interest rates have gone up, the bonds get lesser valued. And if you lose the value on bond, again you are in crisis.
So you've summarized very well for us what has happened so far. But what do you think of the firefighting efforts? The Biden administration is in a huddle. The American president in the morning today, a few hours ago, issued a statement assuring depositors that don't worry, your money is safe. And while the bank will not be bailed out, but the depositor money will be returned. So that's one. What do you think of these efforts? Will it be able to contain the fallout of this and stop the bank run, which we were talking about earlier?
See, there are 4 or 5 major stakeholders in the banking system. One is what we talked about, the depositors. Then you have the bondholders. Then you have the equity holders. Then you have the taxpayers in the larger system. And then you also have the asset holders, the people who have borrowed from the banks. These are the 5 major stakeholders in any banking system. The American system, through the FIDC, this Federal Insurance Deposit Corporation, had a system in place that for an amount up to $2.5 or to $250,000, your deposits are insured. You don't have to worry if your deposits are this much. So that much assurance was there. But in this bank, the Silicon Valley Bank, I am told, these numbers are still to be verified, that a very large number, about 95% or so, the deposits were in amounts higher than
$250,000.
That's correct. And therefore, the large chunk of depositors may not be in number of people, but in proportion of amounts were definitely shaky. So the first step is they have taken, which is unprecedented, is that all deposits are going to be honored, not the deposits up to $250,000. So that's a big step. So anyone, like even some of the Indian startups who were funded through this bank had deposits in the SV bank, and they might have deposits beyond $250,000, and therefore their deposits are safe. So I think one segment they have taken care is this much. The second one, which is the attempt of the American businesses always, is that the equity holders and the bond holders should also be protected, and their protection should or can come at the cost of taxpayers. This is what had happened in 2008. Now the administration so far has registered this and has made it very clear that we will not protect the bondholders and the equity holders, and this will not be taxpayers funded. So there will not be any burden on taxpayers. I think this policy will hold, and if this holds, this is good enough. A legitimate question may arise that if the taxpayers are not to be burdened with the cost of cleaning it up, how come the depositors who are being assured beyond $250,000 are being sort of taken care of? So the statement which the Secretary of Treasury and the Fed chair issued, and also I think FIDC president also issued that this charge, there would be a charge on the entire banking system. So I assume that can be in the form of higher cost of the FIDC deposits. You can raise that charge.
But wouldn't you say that would eventually be passed down to the larger taxpayer base? Because, I mean, can it be called bailout from the back door?
No, that is the distinction which I'm making. So far, yes, this is not a bailout. The taxpayers are not. The depositors will face some of the costs. The larger depositors many of whom happen to be taxpayers, but it's not through the tax payments. It's your higher charge on the deposits you make. It has not been spelled
Right.
out clearly. By the way, the concept of insurance is pooling of the risk. So if the
Right.
depositors need to be protected for higher amounts or the entire set of deposit, the entire base of depositors have to pay the cost of insurance. So I don't think this is bailout, but it's not easy because the system may still pressurize the administration, and if it gets to the taxpayers directly, like it happened earlier, that would be tragedy, because then this kind of behavior which is there, that you can attract deposits at very high rate, you don't care which bank, whether it's a sound bank, what it's lending, what is its asset base, if those are risky, still that deposit is safe. So that would be a very, very bad policy. I think what has been done so far is good enough.
Right. Yeah. The Treasury Secretary categorically said that there'll be no bailout. But of course, the depositors will be allowed to withdraw their money beginning Monday, which is, of course, today. So now, that said, closer home, looking at India, we can perhaps even talk about the financial markets, but closer home, looking at India, if you look at the Indian banking system, one of the things which probably led to this crisis was the fact that Fed had been raising the taxes, the interest rate for the entire last 1.5 years. RBI has also done that in India. Do you think, I mean, to what extent and the Indian banks are capitalized, and what kind of an impact this crisis is going to have on India? Of course, Indian banks are not directly connected to the American banking system, but given there is some similarity in terms of at least the interest rate hikes, I'm talking about the repo rate, what do you think the Indian banking system is looking like?
So there is one critical difference between the Indian banking system and the American banking system. While a good part of the American banking system was exposed to the startups, the cryptocurrencies, these kind of virtual assets and all, our banking system is not at all exposed to that.
Right.
That is not necessarily a good thing, that the Indian banks have not lent to or not provided funds to the startups. Because India's startup story has been built without the due contribution from the banks. But that aside, as far as the health of the banks is concerned, as far as the soundness of the bank is concerned, since our banks are not exposed to the startups directly or indirectly, directly not at all, indirectly very minimally. Therefore, I don't perceive a threat to Indian banking system from this kind of crisis which is coming up. Earlier it was housing, this time it's basically the startup, the private equity and that kind of funding, which we don't have. Now, to address your question about the interest rates, you see, the interest rates in American system has gone up much more sharply. About 450 to 500 basis points in a space of about 12 to 15 months. That is the kind of, from virtually zero rate of interest to this kind of rate of interest, about 500 odd basis point, or 5%. Whereas Indian banking system, the interest rates have gone from somewhere close to about 6.25% or something to about 7.5%. So our rise is much smaller as far as the bonds are concerned. Repo rates have gone about 2% plus, but the bond rates are 1 to 1.5% only. That's not the entire repo rate increase has not been passed on to the bond rates. So as a result, our bond sort of valuation has not gone down that much compared to what the American bond valuation has gone down. So we, those who are holding the bonds as the asset or their investment, are not that much adversely impacted. in any case, our society, our economy is not too much exposed towards the private bonds or private sector bonds. The bonds, basically something close to about 80-85%, is largely the government bonds or the semi-government institutional bonds and all. And therefore, from the bond perspective also, or interest rate perspective also, I don't see Indian banking system that much adversely affected. There is third thing which we are not very clear at this moment. Now it looks that the American interest rate increase cycle might be put to a sort of stop or slowed down or delayed, because the one of the reason why this is happening is because of the bond prices having gone up and the valuations going down. Now this may have very sort of a strange kind of impact which has been there. That dollar might actually strengthen because you have the flight to safety, and therefore the dollar might strengthen. If the dollar gets strengthened, and there is already a kind of outflow from the Indian system to the American system. Our FPIs are sailing, they are withdrawing, they virtually got out of the Indian bonds. If that gets expedited, that we may have some adversarial impact on the foreign exchange front and the FDI financing, because our FDI in last couple of years, a good chunk of that was coming into the startup side through the Ps and venture capital funds. Now that may get adversely affected. So if our foreign investments, both on the portfolio side as well as on the direct side, goes down, then we may have a bit of a crisis on the foreign exchange front.
To what extent would you attribute this crisis to a failure of the regulatory authorities to firstly, of course, ensure that they're striking the right balance while they're hiking the rates up and the amount of liquidity which is available in the system? So first, the first step where they failed was keeping a close watch on this. And the second was, of course, this was allowed to happen, and politics of it aside, as mentioned by Senator Bernie Sanders, that because of a policy which was enacted by Donald Trump when he was the president, which basically allowed banks, it loosened the stringent regulations for banks, and the law raised the asset threshold for systemically important financial institutions from $50 billion to $200 billion. Now, had that not been done, this probably would have come to the light like a lot earlier.
See, there are two issues very important issues which you raised in this question. One is the policy of Fed regarding the interest rates. You raise it so fast, so quick, and that is going to have a certain kind of impact. So whether that policy was right or not. And the second one you raise is the regulatory sort of system arbitrage, or the too loose regulatory regime which might impact. So let me take up that first question first. On the interest rate fronts, you did mention in your question that the Fed was late to react, because it kept on believing for quite some time that the interest rate, the inflation was more of a transitory phenomenon, and therefore, while the government kept on sort of pushing lots of helicopter money and the easy grants and doles and other things in America, which created enormous amount of demand, and with supply disrupted to some extent, the inflation returned, which was not there for last 40 years, which most people didn't expect this kind of return with a vengeance in inflationary front. Now, once that was realized that this is a big inflation, and this is going to stay, the Fed definitely reacted and reacted a little bit furiously, drawing lessons from the earlier policies in late 70s and 80s, that the only way you can kill the inflation is by raising the interest rates. And they kept on raising the interest rate. Now, we can go into that if the time permits, but the situation in early 80s and the situation in 2020s is different. And therefore, the interest rates are not that strong an instrument for controlling the inflation. As a result, what you have seen is that in last 15 months, there is very little impact on inflation and or employment for that matter, whereas the interest rate has kept on going up. I've been raising this, that time has come where we should actually revisit our theoretical as well as strategic concepts, that does the central bank's interest rate play that much part in the inflation management? Because today there is more of asset price inflation, asset price increases which are more significant than the goods or the services inflation. And if you try to deal with a single instrument, it might actually not work for the goods and services inflation. It might work more on the asset side, and what implications this have. So I don't think that Fed was wrong. It had the example, the history that the interest rate works, but it was perhaps trying to do or use the instrument in the setting which is no longer relevant. And therefore, possibly this instrument was not as effective as it could or it was earlier assumed to be. On the regulatory side, I think there is this American sort of tug of war always, where the Republicans always are asking for loose regulations, no regulations, and Trump's decision to raise this to 250 billion from bring it down to 50 and to that from 250 to 50, keeping it low, and therefore keep this out, must have definitely led, because if it was not the case, the signs could have been sort of picked up earlier. But again, I don't think in today's environment you don't know these data. Most of these data are public. The Silicon Valley banks, financials have been analyzed on end. There was a Goldman Sachs report of about, I think, 4 or 5 months back, which was overweight on its purchase. Its share price was so, and all those data are available. So even if the regulator was not intervening, the market had the information. But despite that, market believed. This is what drives market psychology is very different. Mind you, even in our case, there was a proposal, there was a law brought in by the government in 2017-18 to set up a resolution corporation for the banking and the financial sector. This was nixed because there was a campaign run against that. This is against the depositors, etc., and the government is taking away the deposit protections. If this type of crisis were to occur, I am not seeing at all any sign of that in the Indian system right now. But if this were to occur, we will also be without any instrument, without We have put too many eggs in the RBI's hand, both banks and the non-banks, and being regulated in the old style. We may have a problem to deal with, but we are not there.
But let's hope Indian regulators and authorities are watching this closely as this crisis pans out and are taking some lessons from it. On that note, thank you so much for talking to us. For viewers, keep watching this space because this crisis is unfolding. Fourth Bank is also, which is the Pacific Western Bank, might also, go down. But at this point in time, Fed has confirmed that it will be making liquidity available to banks, and banks will not have to sell their securities and bonds. But do keep watching this space. We will keep bringing you the latest. Thank you for watching. Thank you for joining us.